Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is Amcor plc, ticker AMCR. In the next 5 minutes, I will discuss what I think about the valuation of this company and what I think about the quality of this company. Let's dive right on in. First up is to understand the industry. This company is in the containers and packaging industry, and so if we look at the business description, we can learn a little more about it. Develops, produces, and sells packaging products for food, beverage, pharmaceutical, medical, so across the board. Two segments, flexible and rigid packaging. Provides flexible packaging solutions, special cartons, plastic bottles, jars, capsules, and closures. So headquartered in Switzerland. What immediately jumps out to me is one is a short business description, and its containers and packaging is a relatively boring industry. So that gets me a little bit excited that it might be a potentially good idea. The beta at 0.41 tells me it's probably a relatively overlooked company. And so again, even more excited, relatively low volatility, that sort of thing. Now, the important thing here is to understand the return on invested capital. In order to understand a good business, it needs to have a high return on invested capital. But when I look back at 2007, you make profit over the whole last decade since 2007. That's good. No losses is a good first metric to meet. But you never really get above a 10% return on invested capital. In 2015, so 3 years you're above 10%, but otherwise you're in that 5% range, 5 to 8% range, which is a little low, which means you're going to need a lot of debt to really get a good return on equity. But when we go look at the 10-year median returns, I see immediately that return on equity is 19.5%. So I'm guessing they're leveraging up, perhaps in a very intelligent way, to get a good, strong return on equity. PE of 18.5 gets me a little bit excited. I like to target 15 or a bit less, but if you're under 20, then that's in the range where things could start to get really attractive, depending upon the growth rates, especially with return on equity around 19.5%. So what do we see here? We see that revenue looks flat over the last decade, and that's a little less appealing. So I don't really know what's going on there, but if it's truly flat revenue company, then I'm thinking a PE of 8 becomes more appropriate. Assets are growing faster than revenue. That's always a red flag. But free cash flow and earnings per share are outgrowing assets. So they're doing some sort of financial shenanigans in order to get this growth rate to still look good. So what are they doing? We can see that the operating profit has at least doubled over the last decade. That's a good sign. EPS has doubled, but has been mostly not moving much over the last decade. It's really just the last year that's showing that higher growth rate. So despite always having a double-digit return on equity, there's something they're doing here that's really going to require us to dig in a little further. So let's first look at the balance sheet. What's our debt situation? So long-term debt goes from $3.2 billion to $6 billion across the decade. Now, how does that compare to the market cap? We see the market cap is $18 billion, so you're about a third of the market cap is in debt. So that's showing that leverage that's allowing you to get it, really allowing you to boost those returns. Gross profit decreased for most of the decade, but then boosted up in 2020 and 2021. What I'm immediately thinking is they have benefited enormously probably from the pandemic, and maybe that's distorting the short-term earnings. Because if we look simply at earnings in, say, 2019, you had $430 million in earnings versus 900. So it's really doubled in the last 2 years, and that's a big red flag for me because I think something's going on here that's not telling the full story. Although I say that, and the next thing I notice is that the shares outstanding jumped from 1.1 billion to 1.6 billion in that time period. So something is going on here because if for the shares outstanding to jump, they probably made some sort of big acquisition here, which included a dilution factor. So let's go to cash flow and see if we can make a big dilution. You don't see a giant acquisition here. They have a big issuance of debt. So maybe they issued both debt and equity. But I don't see that they bought many assets. They bought a little bit of assets. It must be a lot of goodwill. This would require some more understanding of what went on in 2019 and 2020. So they acquired stuff, which is what it looks like. They did some acquisitions, or they just really struggled through the pandemic. But something weird is going on here that's affecting our numbers, and it makes a reliable analysis difficult. Cash flow from operations is positive every year for the last decade. That's all good. To me, I'm really struggling here because I think Although this is a boring industry and they've probably had some decent returns, I don't like both the fluctuations of this return on invested capital. It shows that the industry is cyclical, and the numbers just aren't high enough to have me comfortable with this company over the long term. Combine that with a growth rate that's not really been strong, and to me, Amcor becomes a pass. It wouldn't even go on a watch list. So despite the earnings ratio being in a relatively interesting area, the company is just simply too expensive for a no-growth company, and it's not a high-quality company for me to consider going forward. Hit that like button on this video. I appreciate you listening. Don't forget to subscribe and hit the bell so you can get notifications when I put out new videos. Thank you for listening, and until next time, stop paying fees, start building wealth.